Hey option traders, for today's trade we're looking at an option play in Iron Mountain. So looking at IRM on MarketSmith, we can see that it's currently ranked number 1 in the commercial services and document management industry group. Shares remain 7% below a 58.71 buy point at this time. The stock has rallied nicely from its mid-July lows as well. IRM also remains above support at its 21, 50, and 200-day moving averages. The relative strength line has been strengthening as well in recent weeks and is currently nearing new highs. The recent move higher was also supported by stronger than average volume, which is a really good sign. Iron Mountain currently maintains a 90 composite rating and an 89 RS rating. Also, EPS for 2022 is expected to rise 36% on a year-over-year basis. So with all that said, we are looking at a slightly bullish trade strategy called a cash secured put. A cash secured put is sort of similar to a covered call strategy, which we've covered several times in recent weeks. It only involves trading one option contract, so you won't be creating a multi-leg spread or anything. We're keeping it very simple with just one contract, in this case a put contract. Remember, with options there are two types of options. There are calls and puts, and with both calls and puts you can either be a buyer or a seller, just like with any stock. You can either buy long or sell short. So to set up a cash secured put, you'd simply need to sell a single put option in a stock while simultaneously setting aside enough cash in your account to cover 100 shares of the stock. You may or may not have to buy those shares, but you need to set aside the funds just in case. As the seller of a put option in the stock, you are now obligated to buy 100 shares of the stock from the put buyer at the agreed upon strike price if shares trade above this price at the expiration date. In exchange for this, the buyer of the contract pays you a premium. The goal is to either have the put expire worthless and above the strike price, allowing us to keep the premium, or to be assigned and acquire the stock below the current price. The main risk with the trade is similar to outright stock ownership. That is, if the stock falls quickly, the trade will suffer a loss. However, the loss will be partially offset by the premium received from selling the put. If the put does get assigned, then the investor takes ownership with a reduced cost basis and can potentially begin selling covered calls to generate further income from the position. If you're considering putting on a covered call in a given stock, you should first ask yourself, do I believe that the stock will trade in a neutral to bullish direction? And am I willing to own this stock if the option gets exercised? If the answer is yes to both of those, then it may be okay for you to proceed in this trade. Put selling is not simply a buy and hold strategy. It involves thinking ahead about appropriate action and possible future scenarios. So for example, if the stock price decline occurs, where will you sell and take a loss? The put seller bears the risk of any price declines in the underlying stock. Depending on the option, you could have a number of expiration dates and strike prices to choose from. This, incidentally, is one of the strengths of options. Options provide you with choices, and investors can analyze a variety of criteria to determine which best fit the needs of their portfolio. Investors must understand that time is a double-edged sword, especially for the buyer. Options contracts decrease in value at an accelerating rate as they get closer to their expiration date. So now that you have a better idea of the mechanics of the cash secured put, let's take a look at my trading platform and set up a real-life trade using the stock we talked about, IRM. So looking at this trade, first you want to make sure you are using ticker symbol IRM. And then you want to be sure that you have the expiration date set for October 21st. And for spread type, if you are on Thinkorswim, it's easiest just to select single. And then looking at the strike prices, we want to find 52.50, which is right here. And we're looking at this side of the screen, which has the prices for put options. And this trade is one of the simplest to set up. It is just selling one 5250 put option that expires October 21st. Investors could look to sell an October expiring put with a strike price of $52.50 for around $2.10 or $210 in total premium per contract. An investor selling this put would receive $210 into their account, which would be theirs to keep. If IRM falls below $52.50 by the expiration date on October 21st, they would be required to buy 100 shares at $52.50. The effective net cost of the position would be $50.40 a share thanks to the option premium received. If the stock stays above $52.50 at the expiration, the put expires worthless, leaving the trader with a roughly 4.2% return on capital at risk. The maximum loss on the trade would occur if IRM stock fell to $0, which would see the trade lose a substantial amount, but most traders would cut their losses long before that happens. Cash secured puts are a great strategy to start with for beginners, but losses could be substantial if you don't manage your position. It's still best to practice in a virtual trading account before risking any real capital. Only try the trade with real money if you have a good handle on the risks of the strategy. Always remember that options are complex and investors can lose 100% or more of their initial investment. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.